Since China's announcement that it was going to relax its currency peg to the US dollar last month, the results have hardly been breathtaking. The yuan has gained less than 1%, which hasn't stopped complaints that it's grossly undervalued, and still gives China's manufacturers a huge advantage in global trade. So is it the start of a long march for the yuan, or just a piece of spin to placate the Americans? Neal Woolrich reports.
In a small manufacturing plant in Melbourne's western suburbs, workers are putting the finishing touches on electrical fans destined for local and overseas car parts markets. Davies Craig has been operating for 40 years, but in recent times has faced stiff competition from a much cheaper Chinese imitator. But now a decision by the Chinese authorities to revalue their currency is taking away some of the Chinese manufacturers' competitive advantage.
It will reduce their margin a little bit, but not much, given that their cost is about half of ours.
Last month, China took some small steps to again revalue its currency, the renminbi, which is also known as the yuan. The People's Bank of China has stopped pegging the yuan to the value of the US dollar and is allowing the exchange rate to move more freely. But it's unlikely to be a seismic shift. The popular view among pundits is that China's currency will creep up a mere 4 or 5% over the next year.
4% won't make much impact, but I've got an idea that the Chinese yuan will appreciate quite a bit more than 4% over the next 12 months, and hopefully the amount of appreciation will start to impact on their margin.
Even though a rising currency will harm the competitiveness of Chinese exporters, the massive factories of China continue to grow relentlessly. And the nation is expected to break the USA's century-long reign as the world's biggest manufacturer sometime in the next year or so.
The GDP of the development zone in 2009 was $900 million. I think in 5 years' time, the figure will be 4 times that.
Overall, I think the appreciation of the RMB will be a positive. Again, they'll manage it very slowly, so exporters will have a chance to adjust to exchange rate moves.
Back in 2005, Chinese policymakers also set the yuan free from its moorings against the US dollar. That pushed the Chinese currency up 20% over 3 years. But the exchange rate was fixed again in 2008 as the global financial crisis took hold. Now China is returning to a policy of limited exchange rate appreciation.
After years of taking on too much debt, Americans will no longer borrow and buy the world's way to lasting prosperity. Furthermore, a strong and durable recovery requires that countries not have an undue advantage. So we discussed the need for market-driven currencies, and I welcome China's decision to allow its currency to appreciate in response to market forces. For example,
the United States has been among the most vocal agents for change, and this week there was uproar in both sides of politics when Treasury decided not to name China a currency manipulator. The US blames China's exchange rate policy for the $200 billion a year trade imbalance between the two nations and for pushing China's trade surplus as high as 10% of its gross domestic product. In the US, the new exchange rate flexibility is seen as a small but important step to help address those imbalances.
And what they've done, if they were to continue this for a number of years, they would bring that surplus down to something like more like 3 to 5% of GDP. That would mean they'd be buying more from the rest of the world, selling less to the rest of the world so that the rest of the world would produce more domestically. And it could make a difference, an important difference in the international imbalances.
But Mark Crosby from the Melbourne Business School says China's currency valuation has very little to do with the US trade deficit, which simply widened further the last time the Chinese currency appreciated.
If the yuan were to appreciate by, say, 20% in the next 3 years, some trade will be lost from China, some exports will go away from China, but rather than moving back to the US as US manufacturing, they'll move to Mexico or Thailand or other countries that are very competitive in that sort of low to medium tech manufacturing space.
UK is a jewel.
James Soutter runs Perennial's Asian Equities Fund and says an appreciation of the yuan will help productivity and wages in China, making the economy less focused on its export-driven businesses.
And as that happens, productivity, consumption from a domestic point of view will become more prominent. So I think we're going to see a change going forward where value-added products, technology, actually become a larger commodity going forward.
But if that shift in Chinese output takes place, it could mean a lower level of demand for raw materials from Australian mining companies than would otherwise have been the case.
But I don't think all is lost for Australia. Agriculture might become actually a very key ingredient for Australia again going forward. As that domestic wealth increases in China, we'll see propensity to want to eat different foods, for instance.
A rise in the Chinese currency could present challenges for Australian policymakers. Chinese investors will have greater purchasing power overseas, so more of them might target the Australian property market, which is already a sensitive political issue. And as Chinese exports become more expensive, that could put greater pressure on inflation here in Australia.
Still, Chinese exports will be relatively cheap. They'll be increasing slightly in price rather than decreasing in price in general, as happened in the past.
But in the meantime, local manufacturers like Davies Craig are finding they need to innovate faster than their rivals can imitate.
You can't compete on the cost of labour, you can't compete on the cost of materials, so you need to be smart.
Whatever happens with the yuan, the Chinese dragon will continue to roar. But if the authorities do plan to eventually have a free-floating exchange rate, the powerhouse economy of Asia will become a very different beast indeed.